Good morning and a warm welcome to everyone. I'm extremely sorry that we could not start the webinar on time due to some technical glitch, and this webinar is on the ongoing Aditya Birla Sun Life ESG Fund, which opened on 4th of December, and this will close on 18th of December 2020. We have Mr. Satyabrata Mohanty, Senior Fund Manager from Aditya Birla Sun Life AMC, who has joined us, who has taken the time on a weekend for us to run us through this NFO, and what is there for the investors and why one should look at making the investment in an ESG fund, especially. Over to you, Satya. You can please take it over from here.
Yeah, good morning, everyone. We will talk predominantly about the ESG fund. But before talking about the ESG fund, I want to briefly touch on my views on the markets and why we are positive on the markets at this point of time. Then I'll talk briefly about the fund. To start off with, my view on the markets at this point of time is that we hear a lot of thing from various participants in the markets, and people say that there is a strong disconnect at this point of time between what is happening at the ground level and where the financial markets are. Because of this disconnect, people think that the financial markets have gone away from reality, and there is an imminent crash that will happen going forward. The primary reason why this is that when the pandemic happened, people were extremely uncertain of how it will evolve, and when countries started going for lockdowns, and India also went down for the world's most strictest lockdown. Everybody knew that once you do such a strict lockdown across the globe, it can only lead to one thing, that is collapse in the GDP. And that is actually what happened, and still happening, and still countries have not come out, and there is recession across the globe, and people, all the countries, most of the countries are posting negative GDP growth rates. So officially, almost large part of the world is in recession, apart from few. So in this kind of scenario, people are telling how come the equity markets have bounced back and are at all-time highs. You have seen equity markets across the globe at all-time highs, stocks at prices at all-time highs, mutual fund NAVs at all-time highs. So why is it happening? So you have to see there is a certain type of recession that happens. There are three types of recession that happen. The first and the most difficult one type of recession is a structural recession. A recession which we call a structural recession. Structural recession happens because when a particular part of the economy, a bubble is created, and excess is built up in that particular sector. And to give an example of that kind of recession, it is if you go back to 2008, the credit bubble that happened. There, what happened was the credit side, real estate side, there was an excess that had built up, which was unsustainable, and that's where the market burst. And because what the market has to do is correct those imbalances in that particular area of the economy, and then the economy will come back to normalcy. This kind of recession takes a long period of time and is the most difficult to tackle, and is difficult to come out of it. And it takes time to come out of this kind of recession. The second kind of recession that we have is cyclical recession. Cyclical recession coincides with the economic cycle of the economy. What happens here is that because the economy is heated up, because GDP growth rate is high, it creates inflationary pressures, and inflation expectation goes up, and inflation goes up. And to tackle the high inflationary part of to tackle this high inflation, central banks tighten monetary policy, suck out liquidity, then increase interest rates, and gradually this reduces interest rates, and this reduces inflation, and then again the cycle comes back to normal. In this current thing that we saw, we have been seeing It's neither a structural recession nor a cyclical recession, because there is no bubble, any part or excesses built any part of the economy which needed correction. So it is not a structural recession, and this was not a cyclical recession because it didn't coincide with the economy completely heating up and with strong growth, high GDP growth rates, and where inflation was shooting up. So it was not even a cyclical recession. So it was a third kind of recession, which we call an event-based recession. Event-based recession is not caused by uh, structural imbalances or by the economic cycle, but it is caused by a particular event, an event which was unanticipated and suddenly happened. So, and here the event was the virus. So this, in this kind of recession, it stays for the shortest period of time, and it's quite easy to come out of it if the government uh, takes adequate measures to revive the economy. And the adequate measures to revive the economy is a strong fiscal stimulus and strong monetary stimulus. So when this happened, the markets corrected sharply because nobody was certain of till, till how long this pandemic will last and what will be the response of the government. But after 1.5 2 months of the pandemic, we saw that there was a strong response from developed countries, and they came out with fiscal stimulus, which was extremely large, and it was one of the highest fiscal stimulus that we have seen in the last 100 years. The kind of fiscal stimulus they came out with and they proposed, and they're proposing is almost similar to what type of fiscal stimulus that is typically given during after wars to rebuild the economy. So that kind of fiscal stimulus was given or declared. So, and we are seeing this fiscal stimulus, this kind of fiscal stimulus after a long period of time. Predominantly, before it was always the monetary stimulus which used to tackle the economic cycle. But this is the first time where a strong monetary policy coupled with a strong fiscal policy, both of them are there together. People didn't choose to do a lot of fiscal stimulus because the thinking was that fiscal stimulus will result in inflation. But we expect that going forward, inflation expectations are moderate, and monetary authorities will also support the fiscal stimulus by keeping interest rates low for the foreseeable future. We might see this lasting at least for 3 to 4 years. So in that kind of scenario, with such a large fiscal stimulus, it can only result in one thing. Eventually, it will lead to higher corporate profit going forward for the coming years. So our view is that corporate profits are going to rise across the globe and in India for the next 3 to 4 years, or for many years. We don't know exactly for how many years, for many years going forward. So increase in corporate profitability. In anticipation of this increase in corporate profitability, the markets have rebounded and have gone to new highs. So we think that going forward, we should expect that GDP will bounce back because of the stimulus that has been given, and then because of the effects of the stimulus will continue for a few more years, and we will see strong GDP growth rates and strong corporate profitability numbers for the next few years. So we might see a phase where there is a multi-year strong outlook for the markets. So that is why we are positive on the markets. So on a multi-year basis from now. So that's the brief view as far as the markets are concerned. And now I'll come to ESG. The ESG fund we have launched. ESG is if you see globally, what is happening is that there has been a lot of shift from active management to passive management. The flows of passive has significantly outpaced the flows of active. So there is a shift that is happening. But one area of active which is gaining market share and growing fastest is the ESG funds. So ESG funds have been gaining market share uh, at the expense of the other funds. So currently, if you see almost 40 billion trillion dollar, $30 trillion is the global size of ESG funds, and Europe accounts almost 46% of the global area. And there has been increasing focus on responsible investing and sustainable investing across the globe, including the US. And gradually it is coming into the emerging markets also. So now we'll briefly touch about what exactly is ESG investing. So there are three parts to ESG investing. ESG investing, one is the environmental impact, one is other is social responsibility, about how it impacts the society, and the third is corporate governance. So what are the parameters that they choose for environment, factors affecting the environment, and social, what factors impacting lives of people, and governance factors impacting management of companies, etc. So environment, there are a few parameters on which ratings are given. So carbon emissions, what are the carbon emissions of the particular company? What is the energy efficiency or measures taken to increase energy efficiency by a particular company? How they tackle water and waste management? How do they tackle deforestation for the expansion? So these are the few parameters that are used to judge the environmental scores of these companies. And then you have the social factors impacting lives, which impact lives of people. So what are the things that have a social impact of things that are taken for social? It is data protection. Suppose for companies like Facebook, etc., which collect a lot of data, and say something like GeoMart or Amazon, which collect a lot of data and keep data of individuals. So what are the data protection and privacy that they're how they tackle that? What is the customer satisfaction levels that how the manager labor management and gender diversity of the company? So these are the various parameters they use for social. And for governance is how is the board composition done? How is the ownership? How are executives remunerated? How is the audit committee structured? Are there any bribery and corruption issues with the company? So all these factors are used to give the overall score for ESG. So what we have seen is that there has been increased focus on this kind of parameters for investing everywhere. So uh, uh, so what happened? Going just 1 second. So somebody is calling. And so sorry for the break. Uh, so what happens is that it also, if you go by ESG investing, it also ensures that there are certain risk measures that are taken, because we've seen for a long in the recent past that there have been certain issues and because of the increased focus by the government and people that companies be responsible towards the environment and governance, etc. There has been a lot of fines, etc., that have been imposed on the companies which don't take these issues seriously. So we have seen, and also what happens because of the flow of money that is coming on people towards this ESG funds. If the company doesn't do these kind of things, then what happens is that it increases the cost of equity and cost of capital for these companies, which has negative impact going forward. So how exactly are we going to manage it? What we have done is that for ESG scoring, what we have done is that we have taken the services of Sustainalytics. So we have outsourced the ESG scoring to an outside um, organization, because we didn't want to do it on our own, because then it would give rise to factors that how we have used, why the score is higher for this company, why the score is lower for this company. So whether there is a bias in scoring. So what we have done is that to tackle all those issues, we have given it we have outsourced it to a global player, which is quite reputed global player. And Sustainalytics scores around 720 odd companies in India for ESG. So we have those 720 companies score for those 720 companies. Then we have around 420 companies which are there in our investment universe. So then we see the overlap between Sustainalytics and our investment universe. So the overlap is around 300, 310. So then what we say is that we will eliminate the bottom 10% of these companies. So we will remove around 30, 35 and we'll be left with around 270, 75 companies, which will be our investment universe. And then what we intend to do is that predominantly focus on the top quartile and the second quartile of this universe as far as the ESG score is concerned, and create a portfolio predominantly consisting of these two quartiles. So, and after the shortlist has been done based on ESG, the weightage of individual stocks, etc., will depend on the financial parameters and the outlook that we have of the company. And apart from that, what we have done is that we also have a negative list of sectors irrespective of the ESG score. So you might have a scenario where a tobacco company has this high ESG score, but still we will not invest in it because it is on a negative list. So the negative list that we have created are mainly will not invest in tobacco companies, will not invest in thermal companies, so predominantly thermal power or coal companies which produce coal. We will not invest in those, and also will not invest in companies which are linked to defense and arms and ammunitions, etc. So these are our negative lists for sectors where we will not invest irrespective of the ESG score. So these companies can have high ESG scores, but we will not invest in them. The portfolio will have a bias towards more structural companies rather than cyclical companies. As per our model portfolio, the sectors where we'll have where large weights will be there, predominantly the IT sector, IT and technology. Then we'll have banking and finance, which will consider around 30-31%. IT and technology will be more than around 20 or more than that. Then there will be decent exposure to consumer durables. There will be decent, and then we will have some exposure to pharma. So that is how the portfolio construction will happen. So with that, I am stopping. I think then we will take questions. And
Sure, Satya. So participants, right on the top of the app, we have a question mark sign wherein you can just click and ask the questions. So Satya, we have the first question, that is, once this ESG fund is subscribed, is it going to also invest in startup ventures focused in on environment and social?
No, it's not going to invest in startup. It will be public equities only. We have a leeway to invest overseas. So we will from the beginning we will not have large exposure to overseas stocks, but we will start gradually. For overseas stocks, what we'll do is that, suppose if we can't say there are certain global trends that are happening in the tech side, etc., like clean energy, etc., where those kind of exposure is not available in Indian markets. So we don't have any companies which make which are in electric vehicles. We don't have any companies which are in battery manufacturing for storing the electricity that is generated by solar, etc. And there are various other technologies that are getting developed. So predominantly, if you want to take exposure to those kind of technology, then we have to go outside overseas and invest. So we'll use that leeway only for that. Our intention is to create a pure ESG kind of fund. Our intention is not to create a fund which is similar to another flexi cap fund, but just because we name it ESG, so we use that excuse to create another similar fund which will look like a flexi cap fund. We will not do that. It will look completely different from our flexi-cap fund. We want to create a portfolio whose weighted average score on ESG is quite high. So we want to create a true to label ESG fund. We know we have a 20% leeway to invest outside of ESG, but we don't intend to use that leeway to invest stocks outside the ESG. So we will only use it to invest in IPOs, because IPOs will not have scores. But if we think that the companies are following strong measures and will score highly on ESG, and so we'll use that lever to invest only in IPOs.
Okay. The next question that we have is from Mr. Rakesh. So he would like to know what is the benchmark index, that you would compare for the returns.
The benchmark index that we are having is the ESG Nifty 100 index. So ESG Nifty 100 index comprises of stocks which are there in Nifty 100. So it's a large cap index. Out of that, after the exclusion of few companies by Nifty, so they have created an index of 88 stocks. And we have seen that over the longer term, the ESG Nifty ESG 100 index has outperformed Nifty 100 by almost 1.3 to 1.5% on a CAGR basis. And we have seen that out of the last 10 years, the ESG index on a year-by-year basis has outperformed the Nifty 100 index 7 times out of 10. And the trend is accelerating as money is, as the focus and the importance of ESG is increasing.
Right.
Yeah.
Go ahead, sir.
However, this will be managed. The asset allocation here will be around 60 to 80% large cap and 20 to 40% mid cap and small caps.
Okay. The next question that we have is from Dr. Kurana. So the question is that since the market is at all-time high, so what is a better option to get into start the investing, whether it would be SIP or through lump sum?
See, I would suggest an approach where you do SIP, and because see, my view is that we'll have a multi-year bull market. I'm quite positive on the markets on a long-term basis. So, but the up move in the markets will also be accompanied by regular corrections that will happen. And we've seen it for all uptrends in the markets are always accompanied by regular corrections, either small and large. So I would suggest an SIP and a bulk allocation when corrections happen.
Okay. So Satya, as you said that this fund is also going to invest outside the country as well. So is there any specific percentage that you have allocated to make the investment in the abroad companies which have high score on ESG?
Yeah, see, as for the orthodox, we can go up to 30, 33, 35%, but we don't want to go that high. So most probably when things settle down and over the medium term, we might have 10 to 15% exposure. But at the beginning, we don't see significant investment. So to start off with, it will be quite low, because it all depends on the stocks identification and also whether we like the valuations at that point of time. So it's not compulsory, though we have a leeway, it's not compulsory that we will invest. We'll invest only when we have an opportunity. And we would like to have 10 to 15% or something like that. We will not go beyond the limit where it will not look where the fund will have low correlation with the Indian stock market. we want to have a fund which is strongly correlated to Indian markets. We don't want to lose the character of being an Indian fund.
Then the next question that we have is from Mr. Amit. He would like to know what is the risk and challenges, for this fund.
So risk and challenge here is that, see, typically with this fund will have a bias towards more structural names versus cyclical names. So the risk will happen is that, say, if the rotation trade happens towards cyclical names and it lasts for a long period of time. Though I think every time there is always keeps a shift keeps on happening between structural and cyclical, but the trend is always in favor of the structural names. But definitely, if, from time to time, cyclicals outperform. So they might also outperform. Whenever that happens, the fund will underperform the broader market. But I don't believe in India will you will have a very long period where cyclicals will outperform the structural stories. So
Okay.
and also in a scenario, so suppose we are not going to invest in ITC, but if ITC people get convinced and ITC doubles, suppose hypothetically it doubles, and obviously this fund is going to underperform. We are not going to invest in companies like say NTPC or Coal India. So when those things come into favor in the market, this fund will underperform.
Yep. Okay. So I think, Satya, we are done with most of the questions. So before we wrap it up, any last comments from your side?
See, what my last comment I would like to give that again about the market. I would like to reiterate our view that we are extremely positive on the markets at this point of time. That doesn't mean a correction will not happen. A correction will definitely happen going forward. Only the thing is that the extent and when it will happen is not known. What I would advise is that whenever this correction happens, please make use of it and allocate money. Then the other thing is that as far as the ESG fund is concerned, we are going to be completely true to label. We will not use any shortcuts and take leeways to get exposure to stocks which don't comply with the ESG mandate. So it will be true to label. We want to make sure that the returns that are generated from this fund will not be tainted by anything, not be generated from companies which have negative impact on environment, which have negative impact on the society, which have negative impact on governance. So we want to create a fund whose returns will be clean. And this is an emerging trend in India, and I think this trend is going to become stronger. So people say that there have been funds which have been launched. So still, there are only 4 or 5 funds that are there in ESG. I think going forward, a lot of launches will happen in ESG. So I think the flow to ESG funds will gather momentum going forward. And from a thematic category, I think it will be currently it is considered as a thematic category, but I think it will become a mainstream category in a very short period of time.
Thank you so much, Satya, for taking out the time on a weekend for us and helping us with all the details of this NFO. And I'm sure a lot of investors who have joined in would be looking to start their investments in this fund, right? And
yeah.
So thank you, participants, for joining in for this webinar, and have a happy weekend.
Thank you to you for providing us this platform to communicate our views on the market and about our fund. So I look forward to future cooperation going forward. Thank you.